When is there the most amount of risk in the stock market for traders, especially for option sellers? And by risk, I'm referring to the potential of a large down move occurring, either a market correction or even a full-fledged bear market. Is there the most risk when the market is already going crazy and people are panicking and selling off their assets? Or is it actually during the exact opposite kind of scenario when practically nobody is fearful and the market is simply climbing higher almost every day? Well, in this video, you're going to find out. And in particular, I'll be comparing two different charts across a long period of time, about 20 years or so. And specifically, I'll be comparing a chart of SPY. This is an ETF that tracks the S&P 500, and comparing that with a chart of the VIX index. And in case you're not aware, the VIX is also an index, just like the S&P 500, except the VIX actually tracks the implied volatility for the S&P 500. And implied volatility, conceptually speaking, is simply a measurement of fear or uncertainty in the market. And so like I was saying, we can compare a chart of the S&P 500 with the VIX index during the same time period to get a gauge of the level of fear in the market at that time. And what I have found by analyzing these two different charts is actually quite interesting because, as you'll see in this video, practically every time the market takes a nosedive for some reason, these events always occur after extremely low levels in the VIX index. Or in other words, extremely low levels of fear in the market. People are basically overly complacent. They're just buying assets left and right, thinking there's very little risk of doing so. But that is actually when there is the most risk in the market. Those are the times when seemingly out of nowhere, it can all completely unravel. And when things finally do unravel and descend into chaos, that's when you'll see an explosion in the VIX index or an explosion of fear. And that's where, if you're not careful, you can get completely blown out of the water, especially if you're selling options like myself. Now, as always, before we fully dive in here, in case you are brand new, my name is Scott Reese, and welcome to my channel where I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. And so with that being said, let's jump on over to thinkorswim now and we'll get things started. All right, so here we are. I did some quick Googling and pulled up a web page here that shows you a list of all the major market corrections and bear markets we've experienced going all the way back to 1950, it looks like. And the data points in blue, these are the market corrections, and then the ones in red, these are the actual bear markets. And in case you're not aware, the major difference between a bear market and simply a market correction is that a bear market has to be a drop of more than 20%. Not sure who made up that rule, it's just the way it is. And so I'm definitely not going to be going over all these data points here, all these different dates. I'm just going to pick 5 of them over the past 20 years. But that's still enough to illustrate my point in that there is the most risk in the market when there's actually the least amount of fear or uncertainty. And that will be shown or described through the VIX index. So beginning first with the most recent bear market that we saw last year in 2020, although this was definitely a very short bear market thanks to the Federal Reserve, but still you can see here with this last data point that the peak that occurred before the major crash happened last year was on February 19th, 2020, and then the market bottomed on March 23rd, 2020, only about a month later, but this was still a drop of almost 34%. So definitely a very large and very fast drop in the market, and now we'll come over to thinkorswim and take a look at that on the VIX index here. Now, before I zoom in and show you that exact time period where the market did crash last year, I do want to direct your attention to this yellow line right there. I know it's a bit hard to see, but this line in yellow is the 200 period moving average. And as per the name of this indicator, every point on this line is the average of the previous 200 data points, specifically the previous 200 data points of the VIX index. So in short, this line gives you a great idea of what the average value of the VIX is over a long period of time. And so of course, because this is a moving average, it is going to fluctuate a little bit across time, but still we can basically get an eyeball estimate here that the long-term average value for the VIX index is somewhere around, I would call it 15, maybe 17, somewhere in there. And in fact, let's call it 17 just to narrow it down to one specific number. So there we go, a 17% implied volatility measurement for the S&P 500 is pretty typical. But of course, as you can see on this chart, there are still many times where the VIX explodes above that level and also drops down below it. And again, as I mentioned, because there is actually the most risk in the market when there is the least amount of fear, that's going to translate to a very, very low value for the VIX index. So whenever the VIX index is super, super low, ideally below the long-term average, that's when you need to be the most cautious. So now let's come up to the flexible grid here. And now we can compare two charts side by side, and the one up top here, this is a price action chart for SPY, basically the S&P 500, and then down here, again, this is the VIX index. And so now let's zoom in here a bit so we can more easily see the crash that happened last year in 2020, and I'll do the same on the VIX chart as well. So as you may recall from the webpage, the market peaked right around here in early February of 2020. And then, of course, after that, all hell broke loose very quickly. But where was the VIX index before all this happened? And so if we come down here to the VIX chart, to the corresponding time period, we can see the VIX was fluctuating right around a value of 14. And so as I just pointed out on the previous full page chart of the VIX index, a value of 14 is below the long-term average. So this means the majority of people in the market were just very complacent. There's hardly any fear, hardly any uncertainty, and if you come back up to the SPY chart here, look what the market was doing during that time. It was simply lazily going up week after week after week, almost in a row, right? Again, keep in mind, this is a weekly chart that we're looking at here. And this kind of price action is very, very typical when there is a lot of complacency in the market or when the VIX is very low. When the masses are not fearful about anything, what are they going to do? They're just going to keep on buying. Buy individual stocks, buy market ETFs, put money into index funds, whatever they want. And then, of course, out of nowhere, it all just completely unraveled and fell apart. And along with that, the VIX index totally exploded and went to near record highs. And this is especially dangerous if you are selling options, right? Because implied volatility is baked into the prices of option contracts, unlike the prices of stocks. And when you're selling options, when implied volatility expands, you're going to lose money when that happens, right? Because this will cause the prices of the options you sold to expand. That's what happens when implied volatility spikes like this. And whenever you sell something as an opening trade, you always want to buy that thing back for a lower price. But obviously, if the opposite occurs, if the thing you sold increases in price and also by a huge amount, you're going to incur a lot of heavy losses, even if they're unrealized for the time being. And this also emphasizes the point that I've made many times in the past of how important it is to stay small with your individual trade size. Because when you do that, and if something like this happens again, chances are you can still manage your way through it. Even though you might have some pretty nasty losses during this time, obviously it did not last very long. And if you were able to survive to this point, chances are you actually ended up making a lot of money. So with that said, let's come back to the webpage here and look at a different data point. You can see back in late December of 2018, there was a 19.8% drop in the market. Let's take a look at that one. So we'll come back here and we'll have to scroll over just a little bit to 2018. There we go. And I'll do the same thing on the VIX chart down here and make sure everything is all lined up. Perfect. And so in particular, it was this drop that data point is referring to. From peak to bottom, down almost 20%. So very close to being a technical bear market. And hopefully you can see a very similar setup both on the SPY chart and the VIX chart compared to what happened in 2020. Before all hell broke loose on the SPY chart here, where was the VIX index? It was hovering around a value of 13, well below the long-term moving average. So once again, most people in the market, the masses or the herd as they're referred to, they're not fearful about anything during this time. And what are they doing? They're just lazily buying everything under the sun. And once more, out of nowhere, which is usually the case, out of nowhere, it all just completely unraveled. And just like what we saw in 2020, along with this huge down move, we saw a very large expansion in the VIX index. Not quite to the record highs that got set in 2020, but still a pretty massive spike nonetheless, all the way up to about 36%. Now let's look at a third data point. And how about this one right here back in October of 2011, another correction of over 19%. So once more, we'll come back to the charts and take a look at that one. So let me adjust the charts real quick here. Okay, so here we are. As you can see on the SPY chart here, 2011 is pulled up kind of in the middle. And then same thing down here with the VIX index, 2011. And for this correction, the bottom of the market was right here on October 3rd. And from peak to trough, it was about a 20% down move, almost another bear market. And so once more, we have a very similar story. Now, there was definitely a bit more chop leading up to the bigger crash that happened, which is why when you go down to the VIX index, it was hovering around a bit of a higher level than the previous points I showed you. So it looks like around this time, the average level for the VIX was somewhere around 17, the long-term average. But still, nothing really has changed here. When the VIX is very low and the market is very complacent, that's when there is the biggest risk of a large down move happening in the near future. Of course, it does not mean that's always going to occur. It simply means there's the biggest risk of that happening. And very quickly, let's look at two more points or two more time periods. And of course, we can't pass on the 2008 housing crisis, right? That was one of the biggest drops we've seen in recent times where from peak to bottom, the market was down by about 56%. And this time period here is definitely much more like a traditional bear market, which lasted for more than just a few weeks. Right, so unlike what happened in 2020, where it lasted literally about 1 month, this bear market lasted well over a year. So we'll come back to thinkorswim and take a look. Let's move the charts. And here we go. So the entire view of this chart now shows the whole down move that occurred in the housing market crash. So like I was saying, this was definitely a more prolonged down move, but you can still find very similar patterns with the previous time periods I showed you earlier. So before everything fell apart, looking at the VIX index down here, where was the average value for the VIX? Looks like it was fluctuating around a value of 11%. And this is actually pretty extreme. You rarely see the VIX index this low. You rarely see the market this complacent. And so it looks like for the first few months of the bear market that occurred back in 2008 and 2009, it definitely started out in a more gradual fashion. So perhaps during this period, if you were selling options or really using any kind of trading strategy, given that neither the VIX index exploded too much, nor was there that much volatility in the actual price action for SPY, chances are trading through this time period would not have been too bad. But eventually in late 2008, everything finally fell apart in a huge way. And that's when the VIX exploded to, I believe, historical record highs. I think the only time maybe the VIX was higher than this point was back in the Great Depression era, although I'm not even sure if the VIX was even around at that point. I'd have to check. But still, the VIX exploding from a value of 19, which is still pretty high compared to the long-term average, nothing crazy, but to go from 19 to just under 90, this could definitely blow option sellers completely out of the water if they're not careful. More specifically, if your position sizing is too large or if you're over leveraged, then chances are when this happened, you would have gone under and never would have been seen from again. And of course, many individual traders and large investment institutions did go under during this crisis. Of course, it was not all from option selling, but a large part of it was in other forms of risky derivative-based trading. And one more thing I want to point out on this chart here, because again, this is a bit of a unique situation, given how long this bear market actually lasted. There's obviously a lot of time for some short-term bear market rallies to occur. And each one of these short-term rallies is paired with a significant drop-off in the VIX. Right? Every time the market bounced, people calmed down. Perhaps they thought that the market was finally going to recover. And that's why all the fear and uncertainty started to go out the window. And so in this case right here, the VIX got down to a low of about 15.8, pretty much business as usual at that point. And then what happened very soon after? It completely unraveled again. And this time in the most severe way. And finally, one more data point we'll take a look at. And let's go to the other big crash that occurred in the early 2000s with the whole dot-com bubble. So once more, this was also a full-scale legit bear market that lasted for the better part of 2 years, or over 2 years actually. And from top to bottom, the market was down by about 50%. Of course, it does vary based on the index you're looking at. The NASDAQ was down a lot more because this bear market mostly had to do with tech stocks, but still across the board, the market was down by a huge amount. So one last time, I'll come back to the charts and take a look. And let me adjust the charts real quick here. And here we go. And once more, this entire view shows you the full down move that occurred from the dot-com bubble bursting. And again, we have the very same exact story. So it looks like it was right around this point before everything completely unraveled over the next 2 years. And taking a look at the VIX index at that point, it was at a value of around 17. So basically right on the long-term average that I pointed out earlier in this video, right? Once again, as you can see here with the SPY chart, we had 1, 2, 3, 4, 5 up weeks in a row. Everyone's lazily buying everything, no fear, no uncertainty, market's complacent, and then boom. Immediately after those 5 up weeks, we had 1, 2, 3, 4, 5, 6 down weeks all in a row, and then a short-term bounce, and then pretty much it was just downhill ever since then. And looking at a holistic view of the VIX index compared to the SPY chart up here, once more you can see that every time there was a short-term bear market rally, a short-term bounce in the market, that was paired with the VIX going down back to normal levels again. And just when the masses or the herd thought that they were finally out of the woods, the market's going to recover and go back to all-time highs again, everything's great, boom, not so fast. And again, you can see that same exact kind of behavior playing out over and over and over again. Short-term rally, coupled with fear and the VIX index going back down to super low levels, and then very soon after, all hell broke loose once again. And so the point of this video is twofold. One, I definitely wanted to show you a couple different examples of how, yes, there is indeed the most risk in the market when the market is the most complacent, when there is the least amount of fear. I wanted to prove that to be true. And then secondly, I wanted to explain how you should handle your trading now with this knowledge. So no, this does not mean you should be preparing for an all-out bear market or a crash every single second that the VIX index is at a low level. Because obviously, even though looking at the past, there were many times where the market did go down by a large amount, this kind of thing does not happen every day, right? Or every week, or even every month, or even every year. That being said, if you do want to be in this game for the long term, ideally for your whole career or your whole life, you do need to scale back your risk exposure when the VIX is at super low levels. And that's especially for if you are selling options, right? Obviously, when the market does go crazy, pretty much any kind of trader could be caught in a bad situation. Stock traders, futures traders, options traders, of course, right? Because simply the price action of the charts just go crazy. So the information in this video is definitely applicable to any kind of trader, but it's most applicable, the most important for option sellers to know. And again, that's because implied volatility is baked into the prices of options. And when you sell options specifically, that's when you are exposed to pretty heavy losses during a very major market correction. Because when those kinds of events do occur, you are basically guaranteed to see a very large spike in the VIX, a very large spike in implied volatility across the entire market, across the board. So all your short option positions are going to experience implied volatility expansion, and chances are you're going to face a lot of losses as a result, even if they're simply temporary. And the only way you're going to be able to survive those temporary large losses is if you stay small, both on an individual trade size and also when the VIX is super low, you also scale back your risk on a portfolio level, meaning you don't have as many positions on at the same time, right? Because when the market is already crashing and the VIX has already exploded, that's actually a good time to get aggressive as an option seller. Implied volatility is high, option prices are high, and therefore it's very advantageous to be selling those very expensive options. Moreover, the vast majority of the time when you do see a major market correction, the VIX typically does not go above a value of maybe 40 to 50. There have really only been a very small handful of times, maybe 3 or 4 times, where the VIX exploded to a value of maybe 80. We saw that in 2020, we saw that in 2008. We may have also seen that in the 1987 Black Monday crash. I'll have to check that. But point being, it almost never happens. So again, if you're selling options around this time period, when the VIX is around a value of 40, 45, or 50, chances are it's not going to go that much higher above that point. So therefore, it's actually a lot safer to be selling options in this time period because you're almost guaranteed not to see more expansion of implied volatility after that point. Moreover, when implied volatility does expand to very high levels, it usually comes back down pretty quickly. And that's exactly what you want to take advantage of when you're selling options, right? Selling options when implied volatility is high and then buying those contracts back when implied volatility is low, because those options will now have much cheaper prices and you can buy those options back for those lower prices and make the difference as your profit. So again, just to recap here, the market does have the most risk of a large down move occurring when the VIX index is very, very low. Or in other words, when the market is simply complacent and most people are not fearful about anything, right? You typically do not want to trade the same way that most people do in the market. Following the herd is oftentimes not a good strategy. And then secondly, because of this fact, when the VIX is very low, scale back your portfolio a bit. Have extra cash on the sidelines. Don't have so many trades on at the same time. And also on an individual trade basis, perhaps make your trades a bit smaller. So scale back your risk during times of complacency and then put on more risk, get much more aggressive when the market starts to go crazy. I know that probably sounds counterintuitive, but in particular, if you're an option seller, that's how it actually works. There is the greatest opportunity and the greatest profit potential when there is the most fear in the market. And so with that being said, that's going to conclude this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.